Good morning, distinguished speakers. Good morning, able participants. Good morning, everyone. Welcome to our maiden webinar series of the Institute of Chartered Accountants of Nigeria. As you have seen from our flyers, the webinar is for 90 minutes, and we have 3 distinguished speakers in the house. I'll briefly introduce the speakers before allowing them to take their speeches. Our first speaker in the house is Omolara Ogun. She's an Associate Director of Audit Services with KPMG. She has gained extensive experience in audit and audit-based advisory services and financial statement compilation. Omolara has over 14 years of professional experience working with clients in various industries and sectors of the economy, including consumer, industrial markets, telecommunication, manufacturing, and so on. In addition to her role, our audit role, she is actively involved in KPMG CFO Forum. Omolara has a degree in business administration and a qualified chartered accountant since 2004. Mr. Omolara, you're welcome. Our second speaker for today is Mr. Oladimeji Oladusun. He's a manager of financial reporting group and assurance services of ICAN-ngr. Oladimeji has over 10 years of experience performing services, including external audit, technical accounting consultancy, accounting compliance, and reporting services and IFRS passion projects. He is an ACA, he is an ACCA, CFA. Mr. Oladimeji also doubles as an audit manager for some clients in financial services industry. He was the financial reporting specialist at American Tobacco Corporations prior to rejoining EY. He also provides IFRS 9 and IFRS 15 implementation support for a number of insurance companies and microfinance banks. Mr. Oladimeji, welcome. And our last speaker for today, I'm sure is a very popular man for our members, which is Mr. Bolaji Osho. Mr. Bolaji Osho is an accountant with in-depth knowledge, experience in information technology as straight to business processes. As we are aware, he's the chairman of the financial reporting faculty of our institute. Mr. Bolaji had anchored training in diverse areas of financial reporting, IFRS, IPSAS support. He's highly knowledgeable in IPSAS, IFRS changes, change management, and embeddlement. Mr. Bolaji, you are welcome. Members, you're welcome to this, once again, to this webinar. I'm sure you all can see us. If you have any question for us, you can see a question and answer button on your screen. Please click on the question and answer button and then write your question. Preferably, you can indicate the speaker to whom you want, the one you want him to answer your question, specific, and after the sessions, we'll be able to take your question and answers. Thank you so much, Mr. Jude. You're over to you now.
Okay, thank you very much, my Registrar Chief Executive. We have 3 papers, and the very first one is on the impact of COVID-19 on accounting and financial reporting and going concern issues. It will be taken by Omolara Ogun immediately after this. The second one is on the effects of the global pandemic on the interim financial statements, IAS 34. That will be done by Timeji Oladusun. And the last one will be on events after the reporting period, IAS 10, adjusting and non-adjusting events. That paper will be done by Bolaji Osho. Immediately after that, we'll have a 20-minute question and answer period. Like the Registrar Chief Executive said, please go to the top right corner of your screen and click on Q&A if you have any question. Send your questions and please direct them to one of the 3 panelists so we can be specific with solutions. So right now, I'll have the pleasure to invite Omolara Ogun for her paper. Omolara, over to you.
Thank you very much. Good morning, everyone. I'm very delighted to be part of this first ICAN session. And as introduced earlier, I'll be speaking on the impact of COVID-19 on accounting and financial reporting and going concern issues. So just a quick overview and to just bring up to speed as to where we are. This is somewhere that we never anticipated that we were going to be, but strangely we are in the situation and everyone is trying to make the best of it. Based on the 100 report for the World Health Organization as of yesterday, is confirmed that the number of confirmed cases is this has resulted in for the global economy. There's increase in mortality rate, there's significant drop in revenues for some sectors, for example, sectors in the tourism and hospitality space. In addition to that, there are also some sectors that are going to have significant increase in revenue, like the telecommunications. Quite a number of workers have been working remotely, and then communication skyrocketed. In addition to that, when we look at the impact of this and the oil price war, which is as a result of the production trying to moderate the prices, all this has impacted on the global economy as well as Nigeria as a whole. When we talk about the supply, then with respect to the demand, because of the impact of COVID-19 on the major contributors for Nigeria, like India, Spain, and Italy, this has also impacted us. Financial-wise, it's reported that the interest rate, for example, will be 4.85% by the end of Q3 of 2010, as well as across the businesses and operating model. On the individual as well, this also has an impact because it put pressures on income and purchasing power on the individuals. Economic uncertainties will be generally on the company. So take, for example, the statement of financial position, and then we look at the financial statement caption, which you have on the left, and then the IFRS pressure points. What we've done is that we've also tried to classify them into categories to say for the COVID-19 impact, which ones will be categorized or which do we consider will be high or medium or low. You will notice that the IFRS pressure points on the non-current assets is mainly around impairment, and is the fact that because of the economic uncertainties that we're in right now, organizations are not able to produce as much as they should be producing. The impact, is significant on some sectors because they are not able to do the things they're required to do. So that creates an opportunity, or people now need to start looking at it, this idle capacity that I have, what am I going to be able to do about it? In addition to that, when you look at the current assets, you have the inventories, you have the trade and other receivables. A lot of people, I'm going to talk about that much later as we move on in the session. But in terms of impairment, people are beginning to get concerned, how much of this am I going to be able to recover? When we look at the liability side, there are quite a number of companies as well that have loans and borrowings and facilities and credit lines that they've gotten such that they're able to do one or one of the capital projects. Well, because of what's happening right now, people are not able to execute on those. What this will bring about is modification of some of those loan arrangements, because people may not be able to repay their loans. They may also be derecognition. On employee benefits as well, we consider that there may be a high impact of that because of what's happening currently. When you look at it, not a number of companies will be able to continue operating at the initial capacity they were operating peak COVID-19 period. So what this will mean is that there may be restructuring. Another one is government grant, measurement of government grant, because there are different initiatives globally. Even in Nigeria in particular, people are beginning to come up with just to be able to sustain the businesses. So these are just some of our views with respect to the impact of this current condition on the statement of financial position. For the statement of profit or loss, we believe that the revenue and cost of sales will be impacted as well. For the revenue right now, collectibility is an issue, and then you now need to begin to evaluate that. Are you sure that you'll be able to recover these amounts that in terms of the revenue and the amounts, will you be able to recover them? Cost of sales, they're likely to be write down of inventories because you may not be able to produce at full capacity. Finance income, we also believe that there will be modification impact on that as well. In addition to that, there are other subsequent event disclosures which will be discussed on later on in the session, and then those are just some of the considerations. In particular, due to time, I would just like to touch mainly on obsolescence of inventories, impairment of financial and non-financial assets, employee benefit accounting, then the impact of multiple exchange rates and devaluation of Naira, as well as the going concern risk assessment. On the obsolescence of inventories, because there's decrease in demand and because there's people are not able to have access to the products that they need to have access to on one side. In addition to that, producers, the companies, the manufacturing companies, for example, due to the challenges, the supply chain disruptions, they're not able to have access to the inventories that they need to hold. What this means is that there may be slow-moving products, a combination of these factors. So companies need to begin to look at it. What do I do with my inventory? And the logistics issue, trying to get items out to people. There's also idle plant capacity, drop in production level. As mentioned earlier, not a lot of companies are producing at optimal levels. All this will result in companies beginning to look at their net realizable value assessment to be sure that they'll be able to carry their inventories at the right amount. And the factors to consider, for example, is going to be the selling price of the goods subsequent to the year end, what type of government policies, for example, have been put in place, and then begin to look at the obsolescence and the deterioration and damage, because before pre-COVID-19, people had done their forecast, they had their production plans, they had an idea of what they thought they would be producing. But because of the uncertainties right now, they are not able to match those forecasts and match those plans that they are put forward before now. On impairment of assets, I know for a lot of people are beginning to look at it and say what exactly is going to happen. The parameters to look at, they are around the loss of job due to the expected economic downturn, levels of profitability. Profitability will decrease as a result of decrease in revenue and increase in production costs. We cannot forget the impact of the devaluation of the Naira as well as scarcity of foreign currencies. There are quite a number of organizations that we know that access to foreign currency will be a challenge for them in this particular period, and then the increase in discount rates. All of this, results of the fact that companies may not be able to recover the amounts that they have set that they will recover. And then I know that quite a number of people are thinking, what's going to be the plan for IFRS 9? Do we just put it away now that we don't even understand? Well, no, you are not going to put it away. Judgment is still required. You're required to consider all of the macroeconomic factors. There's a write-up from the ISB be, for example, and that gives guidance with respect to what we should do in this particular period of COVID-19. And there are two things that you have to look at. You have to be able to estimate the probability of default, and then also look at the government support that has been put in place, accounting model. And it's important that companies are able to develop estimates based on best available information, look at the current events as well as the past events, and come up with forecasts that are realizable. Non-financial assets, as mentioned earlier, people went into investment because they believed that companies were going to have a certain level of return. The organizations that have investment in subsidiaries, the organizations prior to now that they've invested capitally in expenditure, but right now they may not be able to realize that. Then you need to start considering what triggers to consider in this instance. Expected earnings are going to decline because of decrease in demand. There's going to be decrease in expected cash inflow and increase in cash outflow because things will get more expensive than people had anticipated. There will be a decline in the company stock price and market capitalization for listed entities, for example. Then decline in asset value and disruptions to supply chain. All of these and the impact of idle asset because people are not able to produce as much as they should do. Then people now need what's my recovery amount, and the determination of recoverable amount. What you do is that you basically look at it and assess there's supposed to be the higher of value in use and fair value less cost of disposal. These are some of the considerations, and really not business as usual. The evaluation of this is more critical than ever before, and then people need to begin to pay attention to that going forward. Employee benefits is sensitive because we know one or two people that may be affected as a result of what's happening. Right now, companies are beginning to relook their strategies. Quite a number of offices, for example, never even believed that they were able to work remotely and achieve what they could achieve during this period. One of the other things that also comes out of this is that companies are beginning to relook their strategies. Do I really need all the people on ground, and then they're making that assessment. All this will amount in either companies looking at new businesses or downsizing on some that they believe will not be profitable as a result of these economic uncertainties. And then what this will bring about is will bring about restructuring. When we talk about restructuring, what do we mean when we talk about restructuring? Is the fact that a company can decide today and say, I'm shutting down this operation, I'm shutting down this plant. And then what that will mean is that people that work in that plant may be affected and the rest, and there may be specific discontinued operations. For restructuring to be recognized, a formal plan needs to have been communicated. The number of affected employees that will be terminated as a result of that. Redundancy, in terms of the redundancy, you're going to be looking at the obligations regarding payments in lieu of notice. What type of cash flows will go out as a result of termination of employment? What management and companies need to do going forward, especially accountants, as they're closing the financial records, they need to consider the impact of all these demographic assumptions like mortality rate, employee turnover, and financial assumptions used in measuring the defined benefit obligation. It's advisable that companies should do their actuarial valuations very close to the reporting period, and if it's for interim reporting, try and make it close so that the assumptions that you've used will be close to actual, and then that will help you have a number that is close to what should be the actual number going forward. Exchange rate and devaluation of naira it's really difficult. You know, it's one thing for the rate to be high, it's another for the currency to be available. You know, and then there are companies that even have the cash, but the availability on access to that foreign currency is a challenge. And this brings about accounting implications. Accounting implications in terms of initial recognition is the initial recognition needs to be a spot rate of the exchange rate on the, and for subsequent recognition for monetary items, those are translated at the exchange rate at the reporting day, whereas for non-monetary items, those remain at, they are translated at the historical rate and not translated. And for non-monetary items measured at fair value, those are translated at the exchange rate when the fair value is determined. There are multiple impacts for this, and then companies begin to foreign contract window. To use, you know, there are many accounting implications around, you know, and then it's important that you're able to the foreign currency from, because it needs to be verifiable. There are 3 different rates that are applicable for banks. For example, they can use the CBN rate because they have access to that. For people that are portfolio investors and exporters, they have the NAFEX window, and the importers of 42 items, you know, that's approved by the government. All those are contribution tax. All of these factors, you know, the obsolescence of inventory, the impairment of financial assets and non-financial assets, these bring about conditions, and then companies need to assess, am I able to continue as a going concern as a company? And then what do the companies need to do? Right now, borrowers with weaker credit ratings may find it very difficult to access facilities. And then the borrowers with foreign currency denominated debt, it will be difficult for them to service it due to the significant depreciation of the naira. On the other side is the fact that there is a bit stringent now, in new terms, asking for improved collateral, and then covenants in loan agreement conditions that have been established at the onset. Right now, there may be some companies that may be in agreement, and they need to be relook those, see how now they may relook those, shade those low. There are specific steps from the ability to continue that a company has the fact that does the company have reduced revenues? Is there going to be reduction in production? Does it currently have net current liabilities or total liabilities? Is there a low demand of the company's product? Are there falling prices? These are just some of the examples. And then looking at all these uncertainties that we have right now, each company needs to evaluate of which of these ones, how does it affect me, and what exactly is impacting, and the money of now of the team on the and the ISO as well. How to build our plans need to be placed. People need to create a realistic forecast. You need to begin to look at it and create scenarios, because you may look at it that things will pan out once you progress, you are changing. If it told us in lockdown, the travel restrictions, I'm sure everybody would have laughed at it that it was where at now, and then companies need to evaluate that. The step forward will be based on the mitigating factors placed. Is there a material uncertainty? Do you believe, for example, such that you are able to continue as a going concern. And then you determine if there are assurances. Are you going to be able to have access to funding? What will you do about your liquidity? Will you be able to gain access to your raw materials? Those are all the considerations that need to be made. In addition to those considerations mentioned, you look at the future revenues of the company. What is the impact of the current exchange rate? The receivables that you have right now, are you going to be able to recover those receivables? And then the financial health of the key customers and suppliers as well. Fine, you may be able to produce, but are you sure that there are customers available to take using? With respect to the disclosure, your liquidity risk, you're going to close different breaches relating to borrowings, significant judgment. You are making a significant judgment about the company's ability to continue as a going concern. Material uncertainties, expecting you to update the forecast and sensitivities. They need to evaluate cash. Will they negotiate with lenders or restructure some of the loans? What is the financial support that they may be able to get from shareholders? And then, of course, also evaluate the ability of those shareholders to provide the financial support. But a significant number of what I like to live with, KPMG has out there's a lot of reporting websites where you can get access to a lot of information in detail that will help different on the going concern considerations that I just mentioned now, and it's important that you try and get access to the information. We also have the top business risk for 2020 and 2021. I would encourage you to get that information. Right now, it's important to stay on board.
Thank you. Okay, we very much thank you, Omolara, for your presentation. Yeah, we thank you for your presentation, and that was a good one. You still have opportunity to expand on some of the issues through questions and answers. So, okay, next on queue is the paper by Dimeji Oladosu, and it will explore the effects of the global pandemic on interim financial statements, IAS 24. That will be our next paper. But before then, please, I want to plead with everyone to be more specific with your questions, please. Do not ask general questions. Tailor your questions to this very presentation.
Okay, thank you so much. Following from the first presentation, we'll now dwell more on those areas that you need to pay attention to when preparing the financial statement for interim period. COVID-19 is going to change a lot of things.
Yeah, Dimeji, you can proceed.
Everything will remain normal after COVID-19. And the same thing applies to financial reporting. it is going to change significantly, and we need to start thinking about a lot of things now. What are those areas that will change significantly? What do we need to put in place? What are the things we need to consider? What do we need to change? What are those information that will now be more relevant to the users of financial statements? We all agree that there's going to be a recession as a result of COVID-19. But just to probe on it, if I ask you how long the recession is going to last, I'm sure I'm going to have different answers from different participants. Depending on the factors you are considering, there's never going to be a straightforward answer. This is a significant uncertainty, which will also significantly impact financial reporting, especially in the following areas: financial instruments, whether you purchase or you originate, impairment of non-financial assets, the impact of fair value, since we use fair value a lot in IFRS financial reporting, leases. We're also going to consider other matters in so many other areas, and you will agree with me that COVID-19 has an impact on almost everything, but to a different degree. The impact on business is quite severe for some industries. Airline, for example, tourism, hospitality businesses, they've been impacted adversely. And if you think of telecommunication companies and technology, this seems like a positive change for them because many people now need to work remotely. We need to rely on technology and communication. All these industries, whether purchase or originate financial instruments, be it financial liability, financial assets. And this is going to impact how we account for this financial instrument, depending on the changes we come across. And the major areas that will be affected are expected credit loss, contract modification, and one significant area of disclosure, which is concentration risk. All these things are not new requirements, but what we are saying is that we need to pay a lot of attention to them in 2020, especially for those that are doing interim reporting. Just think of it. If you are preparing financial statement for the interim period ended 30th June 2020, we are still in the middle of COVID-19. You don't even have the full information necessary. How is this going to affect your reporting? So what are the areas you should pay attention to? In terms of ECL, things you should start thinking of right now. Remember, the requirement of IFRS 9 is that we should use information that are reasonable and supportable in determining the amount of credit loss. What do we consider to be reasonable and supportable information? Considering the fact that there is no historical precedent for what we are experiencing right now. We actually don't have any information in the recent past that we can say, whenever there is a pandemic, this is how things turn out. At least nothing is recorded in the recent history that will be relevant to financial reporting in 2020. This is like a new thing. So we need to start thinking of what we consider to be reasonable and supportable. Also, financial instruments are likely to have been segmented into different portfolios. We need to reassess now whether the segmentation is appropriate or there is a need to resegment based on changes in risk characteristics, or maybe because have a new thing coming on and we now need to disclose further. Think of whether you've originated or you have concentration of risk in airline, tourism, and hospitality business. You also need to look at the portfolio you assess collectively. Is it still appropriate to assess impairment on a collective basis or individual basis? Remember that each entity will be affected by this COVID-19 based on their response. Although it might have a general impact on the industry, but the response of each entity will affect how they are able to adapt, all right? There's also likely to be extension of payments, maybe due to a government response. There's lockdown, there's going to be delay in cash flows, you might need to grant economic incentives to your borrowers and so on, we need to look at the impact of this. How will it affect impairment of financial instrument? Because there is an extension, can we conclude that there is a significant increase in credit risk, knowing that that is going to affect the amount of impairment you are going to recognize? Also, it is possible that the model you have now cannot show the true value of ECL under a pandemic scenario. You will need to consider management overlay, because if the model cannot capture it, then we need to make adjustment outside the model to ensure that we have recognized enough ECL. Will additional disclosures be necessary so that users of financial statements can have information that will be useful for decision making? These are things we need to think about. Now, for preparers, there are certain things you need to do immediately, and there are also certain things you need to look at in the long term. If you are preparing for June, for example, you need to start thinking of how government relief is going to affect the amount of impairment you are recognizing. You need to start thinking about how you are going to come up with information that are reasonable and supportable, especially when it comes to macroeconomic data. Remember, like I said earlier, you don't have historical information. In calculating ECL, we use past information, we use current information, and we use reasonable forecasts, all right? And when it comes to using macroeconomic inputs, it has to be reasonable and supportable. The fact that there is no history is going to make that a little bit difficult. So we need to start thinking around that. Is there a need for management overlay in case your current model cannot capture ECL under a pandemic scenario? You might need to do robust sensitivity analysis to check your key assumption and judgments, just to buttress the fact that they are actually reasonable and you can support it. The role of governance is very, very important. As all these we need to take it very, very important. You can't just adjust model without proper oversight. There should be no value without proper understanding and oversight. All these things are very, very important. And there's likely to be constraint on resourcing. Remember that a lot of people are working remotely. There might be a need to do something significant on your models, which will be affected by government response to this pandemic. These are things you need to do in case you are preparing financial statement for June. In the long term, you start thinking about to adjust your model so that it can give you something useful under a pandemic scenario. Default rate will change. What we consider to be downturn is going to change. Remember, we are saying everyone knows that there's going to be a recession, but to what degree? You might have multiple scenarios under a recession. Also, what are the IFRS trigger and how are those linked to risk management? You need to manage those ones in the long term. And enhanced monitoring and control of this particular area because of remote working. Risk management is important. So we might need to adjust the risk appetite of the entity, the framework, the approval limits, and all these things will be disclosed in the financial statement when you are talking about risk management disclosures. So if you are preparing June 2020 financial statements, you have to consider all these things. Also on contract modification, there are a number of things that could make your financial instrument contract to be modified. Think of additional financing that will be required by your borrowers, maybe because they now face higher operating costs. They've lost some of their revenues because their customers are no longer taking their delivery. They need additional financing so that they can survive in business. This is likely to lead to modification of your financial instrument contract, but we need to check whether you're applying modification accounting in the strict sense of it, all right? Even without additional financing requirements, there could be an amendment to existing debt agreements simply because they are unable to meet, the agreed debt covenants or the project they are financing due to the impact of the pandemic. The cash flow projection is going to change, or the timing of the cash flow is going to change, and they will not be able to meet their obligation as and when agreed, all right? There might be a need to amend existing debt agreement. In addition to that, you might need to grant them temporary economic relief due to the disruption we all face. You need to assess very well whether modification accounting will lead to derecognition or will not lead to derecognition. In case of financial liability, there's detailed guidance on that in IFRS 9, and we normally apply what we call the 10% test, saying if the difference between the new financial liability and the existing one is more than 10%, we consider that to be a substantial modification, which will lead to the recognition of the existing financial liability, then a recognition of a new one. All right. It should be noted that in some cases, we don't meet this 10% threshold, but we still go ahead to derecognize because of qualitative factors. Think of a situation whereby you have a financial liability that is measured at amortized cost, simply because it meets SPPI test, but we are replacing it with another one that contains some element of equity. Even without meeting the 10% threshold, you might need to derecognize. For financial assets, it's a little bit difficult because there is no explicit guidance. Judgment is required. Each entity normally come up with its own accounting policy, which will consider a mix of qualitative factors and quantitative factors. The IFRS Interpretation Committee has already noted that a 10% test used for liability might not be always appropriate for financial assets in all cases, all right? So when we are talking about the modification of financial assets, to consider whether it is significant or not, we are likely to pay more attention to qualitative factors. And the fact that you are granting temporary relief to your debtors does not mean there's already a substantial modification. Think of a receivable that is due in 90 days. But because of the pandemic, you have allowed them to hold it longer for, say, 180 days. The appropriate accounting treatment. So apart from ECL and contract modification, concentration risk is another thing we need to pay attention to, because the requirement is that you need to disclose the concentration of risk if it is not apparent from your risk management disclosures. Now, before now, you might not really pay attention to it because you don't believe the adverse impact is quite significant. But because of the impact of COVID-19, you can think of a bank that has a significant exposure to the airline, hospitality, and tourism industry. They might not consider that to be so significant to them and does not warrant special disclosure before now. But due to what we are facing right now, we need to understand how management determines their concentration risk. And we also need to understand concentration of risk among shared risk characteristics. And we also need to know the risk exposure of entity to each of these risk characteristics. And you also need to make adequate disclosure of the key judgment and ensure that everything is presented fairly so that users of financial statements have adequate information to make informed decisions. So on financial instruments, you must pay attention to ECL, you must pay attention to contract modification and how to account for it, and you must also pay attention to concentration risk. Apart from financial asset impairment, it is important for us to also consider the effect of COVID-19 on impairment of non-financial assets. Remember, to be impaired once the carrying amount exceeds the recoverable amount, all right? Recoverable amount in this sense, say it is higher of what we consider to be the fair value less cost to sell and the value of the asset if the entity continues to use it. The standard does not require that you test all assets for impairment annually and even at interim period. But remember that for some items like goodwill and intangible assets with indefinite useful life, we do an annual impairment test or when indicator of impairment exists. So if, for example, you always do your impairment test on goodwill at the end, you might still need to do impairment of goodwill as at June reporting if indication of impairment exists. For other classes of assets, you assess at each reporting date that there is indication of impairment. If there is no indication of impairment, we move on. If indication of impairment exists, we do proper assessment. One indication we need to pay special attention to is decline in price of shares and commodities. If due to COVID-19, the share price of an entity has fallen significantly, then that could trigger an impairment. If the market capitalization of the entity falls below the book value of equity. In Nigeria, many companies need to pay attention to that, because if you look at the market capitalization of so many entities on the Nigerian Stock Exchange, even before the pandemic, they fall below the book value of equity. So now consider after the pandemic that there's been a further decline in these stock prices. Doesn't mean there is an actual impairment, but you should be able to explain why impairment loss is not recognized if you conclude that there is no impairment on the entity's assets. In addition to that, you should also be able to explain why users of financial statements, market participants, and the like have placed a significant discount on the price of the entity shares to make it fall below the book value of equity. Other factors that will trigger impairment are plant shutdown. This could be because of the response of to curb the impact of the pandemic, closure of shops, reduction in demand and the demand for certain goods, maybe because they are not essential, decline in selling prices because you now need to sell more, you might need to, and so on. So we need to consider all these factors to know whether a detailed impairment test will be required. When you are calculating your fair value less cost to sell, remember you are looking at it from the point of view of the market participant. It's an hypothetical sale price, looking at the exit price of the asset under consideration at a particular measurement date. Since we are looking at non-financial assets, in line with the requirement of IFRS 13, we need to determine the fair value based on what we consider to be the highest and the best use. So far, it is legally permissible, physically possible, and financially feasible, all right? And you also need to bring in the impact of synergy. If market participants will be expected to use that particular item with other assets that are readily available to the market participant. You are looking at fair value as if the asset will be sold. When you are considering value in use, you are looking at it from the point of view of the entity, as if the entity is going to use it for the remaining useful life, then also realize the residual value, all right? Internal use is the purpose. Synergy is also considered. So all these things, we need to bring them into consideration. How we are going to recognize impairment for June reporting. If you happen to have impairment of goodwill, remember goodwill impairment can never be reversed. So even if you impair your goodwill as at June for your interim reporting, at the end, you cannot reverse it. So even if it is recognized at interim period, it cannot be reversed at the end, assuming there's been an improvement. So many entities will restructure because of COVID-19. Do you take the restructuring into consideration when determining impairment? The answer is both yes and no. If there is already a commitment, then it is a yes. You take the restructuring into consideration when determining the impairment of your non-financial assets. If there is no such commitment, you cannot take it into consideration. A mere plan does not qualify as a commitment. Because we know everybody is going to respond and they have a plan in place to respond, is not sufficient enough for us to take it into consideration. As at the time of reporting, you need to check whether the plan has been approved by management and it has either been implemented or communicated to those that have been affected to the extent that it has created a valid expectation, a form of constructive obligation for the entity. So if there is no commitment on restructuring, you don't consider it in your impairment test. Also, note whether the disclosure you are providing is relevant. This is a point where we need to do away with boilerplate disclosure, whereby we just copy template and adjust. You have something in front of you. Users of financial statements need new and relevant information to make their decision. Your disclosure is going to be dependent on whether your recoverable amount is your value in use or your fair value less cost to sell. But at the minimum, you need to disclose the significant estimate and judgment you have, the sensitivity analysis, ensure that it is presented fairly, disclose your key assumptions, the valuation method you use, the inputs. In case of value in use, you are going to disclose the discount rate and your impairment figure recognized. So take all this into consideration. If you don't have anything in place already to trap all this information, you might need to start considering them. Don't wait until the time of reporting before you start doing all these things. Fair value is used in different areas of financial reporting, for those that are non-recurring, to those that are recurring, and those that are only relevant at initial recognition. Remember, for non-financial assets, the fair value should reflect the highest and best use. It should reflect the condition at the measurement date for any fair value you are recognizing, and try as much as possible to maximize observable inputs and minimize the use of unobservable inputs. There are a number of things you should consider in your valuation, all right? Remember that fair value is not the same thing as first sale value. It is not the same thing as fire sale value, all right? We are looking at it from the point of view of market participants. They all have adequate knowledge of the market. They are willing buyers and willing sellers. Fair value is known or it is knowable at the measurement date. Sometimes judgment may be required, especially when it is not actively traded. You might need to consider some macro variables. If it's something you've been doing in the past, this is the time to look at them critically and check whether there is need for
Hello, Dimeji.
Hi.
Hello, Dimeji.
Hi.
Yeah, please, you need to round off now, please.
So look at recent transaction, then look at when it's actively traded, right? You also need to look at the extent that event after reporting period will be necessary. This is another area that you need to consider, the modification to leases. There is a recent exposure draft published by the ISB with a comment period of 14 days. I will encourage everybody to pick it up because what it gives is a practical experience. If there is a change to your lease because of COVID-19, you don't have to account for it as a lease modification in line with IFRS 16. Remember, IFRS 16 is a new standard that became effective 1st January 2019. So look at how that practical experience is going to affect any modification you have to your leases as a result of this pandemic. So there are certain conditions there. I will encourage everybody to pick it up and look at. Other areas you should look out for, if you have onerous contract provision, it's very likely now that there's disruption to global supply chain. Remember, before you recognize any provision, you must first test for impairment any specific assets recognized in respect of that contract. There could be modification to your revenue contract as well. You might need to revise your estimate of variable consideration. Look at government grants. All government responses are not necessarily government grants. So this is time for you to look at government grants or government responses critically to look at whether it should be accounted for in line with IS 20, whether it should be considered or an integral part of contract within the scope of IFRS 9, or whether it should account for it as a reimbursement asset in line with IS 37. Look out for inventories, reassessment of your deferred tax assets, whether you are still going to have sufficient taxable profit in future period. Look at impairment of other investments like equity accounted investments. There could also be a change in plan to asset held for sale. Improve, all right? Disclose the nature and assumption and other estimates, sensitivity of your carrying amount, explanation, and so on. Thank you so much.
Okay, thank you so much, Dimeji. Thank you for that presentation. It was a good one, but I will come back to you with some questions if time permits. So let me please beg everyone to not bother about the slides. The slides will be made available to you. We had said that earlier. They will be made available to you after the presentation. So just concentrate on the presentations, and then if you have any questions, please send them across through the Q&A. The final presentation will be done by Bolaji Osho, the senator, and it's on the events after the reporting period, IAS 10, adjusting and non-adjusting events. Mr. Bolaji.
Thank you very much, Chief Jude Soniegbo. Greetings to all participants. After looking at the financial and COVID-19 pandemic, have been asked to start a conversation around the events after reporting period, i.e. events that are between balance sheet dates and reporting period. Now, the I will want us to begin from the trajectory or chronology, if you like, of COVID-19 pandemics. The World Health Organization declared COVID-19 a global health emergency sometimes in January 2020, and it became a global pandemic sometimes in March 2020. So for entities with year end 31st December 2019, there is a general consensus that COVID-19 pandemic is indeed a non-adjusting event. I encourage us all to see FRCM publication of April 22, 2020. It's a document that is thoughtfully articulated and indeed a robust compendium that I recommend for all financial reporting practitioners. So for entities with year end 31st March 2020, COVID-19 pandemic is likely to be an adjusting event, necessitating remeasurements of assets and liabilities. So what this means is that for entities with year end in between 31st 2019, 31st December 2019, and 31st March 2020, management will need to exercise judgment as to whether COVID-19 is an adjusting or a non-adjusting event. So if your year end was 31st January 2020 or 29th February 2020, judgment will need to be exercised whether COVID-19 is non-adjusting or adjusting, bearing in mind that if you're 31st 12 2019, COVID-19 will likely be a non-adjusting event. If you're 31st March 2020, COVID-19 is likely to be an adjusting event. So if you fall in between these two dates, what factors, what variables will aid management in making this judgment call? It will range from the jurisdiction in which you operate. For us in Nigeria, or indeed Africa, COVID-19 or the impact of COVID-19 became more significant for entities with period end 31st March 2020. But for entities operating in China or Italy, the impact became more significant much earlier than it was for us. We may also want to look at the industry in which you operate in making this judgment, because certain industries were impacted much earlier than others, e.g. tourism, hospitality, airlines were impacted much earlier than for others. In addition, other general considerations like the entity's customer base or potential disruption to the entity's supply chain. So if the larger percentage of the entire base are in China or Italy, chances are that you'll have been more impacted much earlier than if it wasn't. Same for supply chain. So this segment or sub-segment of the webinar focuses on IAS 10 impact of COVID-19 and how to consider and treat information that comes to life after the reporting date. So for COVID-19, there are two events, i.e. events that took place between year end, at the risk of sounding repetitive, the date the financial statement is authorized for issue. The first one is events that provide additional information about the spread of the virus, the related costs, other implications that existed at the balance sheet date. Those might be adjusting events, and events that are indicative of conditions that arose after the reporting period, such as the announcement or enactment of new measures to contain the virus or decisions taken by management. These are likely to be non-adjusting events. Now, caution, even if the events or the impact of COVID-19 is a non-adjusting event, disclosure might still be required when this is material to the understanding of the financial statement. Now, for adjusting events, I want us to quickly consider an exception to adjustment. So what it means is, even if an event appears to be adjusting, if these exceptions applies, we will not adjust that particular element of financial statement. If you recall, elements of financial statements are assets, liability, equity, income, and expenses. So prior to delving deep into the subject matter, it is advisable we discuss an important adjustment exception provided for by IFRS 13. Certain assets and liabilities are measured at fair value within the scope of IFRS 13, fair value measurement. These are not just financial assets. They also include investment property, biological assets, property, plants, and equipment measured using revaluation model, right of use assets measured either using fair value model or revaluation model. So even when adjusting event necessitates the measurement of this element, caution will need to be exercised so as not to violate the requirements of IFRS 13. So this is the definition of fair value based on IFRS 13. You have it somewhere in paragraph 9. The point I want to give visibility to here is that measurement is as at a measurement date. So it's at a particular cutoff date. So what's the implication of this? Assets and liabilities that are measured at fair value are treated thus. For level 1 input of IFRS 13 hierarchy, no adjustment is required, even for adjusting events. But for level 2 input of IFRS 13 hierarchy, reasonable adjustment, not so much, is permitted. Otherwise, the hierarchy falls to level 3, necessitating broader disclosure. So for emphasis, IAS 10 does not require an entity to make any adjustment for events after reporting period on assets and liabilities that are measured at level 1 input. So what happens to level 3? If an asset or liability is measured at level 3 fair value hierarchy, an entity should adjust its own data if reasonably available information exists. After the balance sheet date indicates that an hypothetical market participant will have used a different level 3 input at the reporting date. So asset and liability measured using level 3 input might be subject to extensive adjustment based on IAS 10, provided the conditions are adjusting events. So what about other assets that are not measured at fair value? Okay, so you have many others, inventories, you have provisions, you have prepayments, you have property, plant, and equipment. You have property, plant, and equipment measured at assets that are not measured at fair value. IAS 10 principle here is whether the impact of COVID-19 provides evidence of conditions existing at the reporting date, which is adjusting, or merely indicative of conditions that arose after the reporting date. So let's quickly delve into examples of events that are considered adjusting, with the exception of assets and liabilities measured at fair value, with level 1 inputs. The point to remember in all of these examples that I want to cite, of course, they are there in IAS10, you have them in paragraph 9. The points to emphasize with these examples are that the substance, the economic phenomenon giving rise to these assets and liabilities had taken place as at year end, but probably additional information arose after year end, but the substance of the event existed as a year end. So to start with, settlement after reporting date of the court case. So you've been into a legal tussle and you had made provision, but the court determined the outcome of the case after year end, giving rise to payment in excess of the provisions you had made, or maybe less than the provisions you had made. You go back to year end and adjust the provisions. What about bankruptcy of a customer? This is indicative of the fact that the receivable that existed in your balance sheet as a year end was already credit impaired. So you go back to the year end and make the adjustment, i.e. bankruptcy of a customer that exists between year end and before the financial statement is authorized for you. Sale of inventory. You know that IAS2 requires that inventory should be measured at the lower of cost and net realizable value. So if inventories are lower than the carrying amount, is an indication that you had infringed on IAS2. So you go back to year end and write down inventory to net realizable value. What about cost of asset purchase or proceeds of assets sold? So you have bought the asset as a year end, or you have sold the asset as a year end, but the substance, the economic phenomenon was not fully agreed into by the two parties until after year end. You go back to year end and make the adjustment. For profit sharing and bonus payment, many organizations declare bonuses, profit sharing to their employees. These are almost always never finalized until after the audit. So you go back to year end because the audit is almost always concluded after year end. You go back to year end and make the adjustment. Discovery of fraud. You were carrying a cash and cash equivalent in your balance sheet at an amount that, that you thought reflected the substance of the asset, only for you to discover after year end that a fraud had actually taken place. You go to year end and recognize that expense, that loss of to the tune of the fraud that existed. Okay, so that's all for adjusting event. What about for non-adjusting events? I need to go through all of this, but in the events that I'm unable to cover them all, what I want this slide and the next slide to resonate in our consciousness is that this event actually arose after year end, and there were no substance, no phenomenon relating to those events as at year end. So to that extent, these are treated as non-adjusting events. Notwithstanding the fact that they are non-adjusting events, there might be need for disclosures, particularly if their impact is significant to the understanding of the financial statement. So examples would be fair value of investment. This ties into what I said about IFRS 13. So when you had an investment measured at a particular amount, and then there was a subsequent decline because of COVID-19, after year end, you don't touch the carrying amount of the assets. You just leave it like that, particularly if it is level one inputs. What about major business combination after reporting dates? Non-adjusting. Announcement to discontinue an operation after year end, non-adjusting. Purchase of asset after year end, disposal of asset after year end, IFRS 5 reclassification after year end, government taking over your assets after year end. These are all non-adjusting events. Destruction of major production plants. These are all non-adjusting events. Now, you have all of these examples as non-adjusting events because they took place after year end. Omolara has given some thoughts to this going concern. It is just important that we quickly have a conversation on it. Management should consider the potential impact of COVID-19 and the measure taken to control it when assessing the ability to continue as a going concern. We have airlines that are already paying the employees 20% of their salaries. British Airways announced that a third of its employees are going home. Airbus announced recently that about 150,000 of its employees are going home. So these are not normal times. COVID-19 pandemic has brought an assumption of an entity. Now, the point to emphasize on this slide is going concern are adjusting events. It does not matter what event happened, when it happened, how it happened, to what extent it impacts the going concern assumption. It is an adjusting event. Now, there are a number of disclosures that you need to make. If there are changes to the going concern assumption, you need to disclose it, even if you are still a going concern. On the final note, there are other considerations. I'm rounding up now. Onerous contracts, COVID-19 will have made a number of contracts become onerous. You need to make provision for it. Redundancy and restructuring, Dimeji and Omolara touched on them. You need to make provision for it if the plan has been made formal and is communicated, and to the extent that it gives rise to expectation in the minds of the stakeholders. Impairment on non-financial assets, Dimeji touched on it. Expected credit loss, Dimeji touched on it extensively. And then the final point for me is that because of COVID-19, if there are significant income and expenses of income and expenses of items of income and expenses occasioned by COVID-19, they need to be separately disclosed either on the face of profit or loss or in the notes to the financial statement based on IAS 1. On this note, I say thank you very much for listening to me. We'll be happy to take your questions.
Thank you so much. Thank you so very much, Mr. Bolaji Osho, the Senator. So we'll very quickly go to questions. So this is question and answer time. Okay, so our first question will be taken by Omolara. Hello, Omolara.
Hello.
Yeah,
Yes.
so you take the very first question, and it's the question goes to us: how can companies mitigate against the risk of COVID-19 in their financial reports, most especially those in the oil and gas sector, in view of the decline in oil prices globally?
Okay, so it's just basically some of the things that I've touched on earlier. You know, when the company looks at their statement of financial position and the profit or loss, what are the impacts that they will have considering COVID-19 on their businesses? If they have receivables outside, for example, are they able to recover them? So those assessments are similar to what every other speaker has touched on, you know, and then what exactly are you doing in terms of your foreign currency? Do you have exposures, or, you know, are you able to continue operating? So those are the things that you need to consider. It's not totally different depending on the sector, but if you are a sector that is impacted, then those considerations are similar.
Okay, thank you very much. Thank you. So Mr. Dimeji will take the next question, and it's from Malam Nasiru Mohammed. First, the page with government grants, you know, he thinks you meant government agencies, not government agents. So there is need for wider explanation of such grants and soft loans and the relevant applicable recognition, particularly with respect to short-term and long-term nature of the grants and loans, as well as change in rate for the same facilities due to the change in period. Please, let me take that again. First, he made a slight correction that maybe you meant government agencies, not government agents. That is just a minor correction. And then he goes on to say There is need for wider explanation of such grants and soft loans and the relevant applicable recognition, particularly with respect to short-term and long-term nature of the grants and loans, as well as change in rate for the same facility due to change in period. Could you please respond to that?
For government grants, in this particular time, you will need to look at them one after the other, depending on the specific one you are looking at. Like I mentioned earlier, any response from government does not necessarily mean government grants in the scope of IS-20. If it is a response from government that is an integral part of the loan, all right, you need to assess whether it is something you should consider in the line of IFRS 9. So there is no one-size-fits-all answer to that particular question, depending on the specific thing you are looking at. So if you have, say, for example, a direct loan that comes at below market rate, that could be some elements of IFRS 9 and also some elements of IS-20. And in some cases, if it is not an integral part of the financial asset, it could be something that will be a reimbursement asset in accordance with IS-37. So each of the response must be considered in their own merit. So there's never going to be a general answer to that. Thank you.
Hello, are you
Okay,
done?
so can I also give a rejoinder to what Dimeji just said?
Go ahead, go ahead.
Okay, so Dimeji is absolutely right. Just an addition to it, because I remembered you mentioned, the question came from Mala Mohammed, that Dimeji meant government agency, not government agents. In the context of IS-20, paragraph 3, government includes all its agencies, whether it is agents, whether it's department, whether it's parastatal, whether it's extra ministerial department, they all form the definition of government. So government agent and government agency are indeed in this context used interchangeably. That's just a little addition I thought I needed to add.
Okay, thank you, Mr. Bolaji. Please, you take the next question. And it's whether you think that companies exempted from the shutdown, you know, companies in the medical sector, like pharmaceutical companies and hospitals, do you think they should disclose this fact in their financial statements?
Okay, there are no limitations to disclosure to the degree that it will help the users of financial statements to understand the economic phenomenon of the transaction entered into. And to the extent that it provides additional explanation, yeah, anything can be disclosed. But under what heading? The fact that you were exempted as an essential service organization, under what heading will you disclose it? I think such disclosures might not only be redundant, it will not provide any relevant, you know, financial statements, or rather information are said to be relevant if it influences the extent to which users can make informed decisions as to whether to subscribe to your shares or whether to sell, hold on to the existing ones they bought, or extend additional credit line to you, and so on and so forth. Because financial statements are meant for the primary users of financial statements, which are investors, creditors, and other lenders. So question is, disclosing the sensitivity or the essential nature of your industry, of your organization as an entity, I think such information will be redundant.
Okay, thank you. Thank you very much. Omolara, please, you take the next question. And what will happen to the already approved budgets? Are they to be altered or adjusted to fit in with the present situation?
I'm taking it that this relates to budget, for example, that companies have made. As a company, in as much as
2020 budget already approved.
So in as much as you have the budgets approved, you need to build in your forecast. And remember when I was speaking, I mentioned creating different scenarios to ensure that you're able to cater for whatever is going to happen. Right now, we don't know when this will end, so it's important that you continue to evaluate. And in making this forecast, you do not only put into consideration past events, you also look at current events as well as the realities, what type of industry are you operating in and what are the likely impacts, and then how do you emphasize that this will continue to happen and the continuous impact on your organization as a whole. So that those are the things that you need to consider. You're not just going to leave it because it's been approved. You need to be able to ensure that it's realistic.
But I guess no one would have forecasted that this kind of pandemic would have this kind of devastating global impact.
Okay, so Chief Jude.
Go ahead.
Omolara, I thought Omolara was still saying something.
Yeah, I agree with you that no one thought something like this will happen, but such is life. We're in the situation and we definitely just have to try and make the best of it. I've heard of companies that on a normal day what they produce is drink or juices. Now I'm hearing that some of them are producing hand sanitizers. So right now organizations are beginning to relook their structures, as they producing the things that they believe there's a demand for. Even the ones that have a demand, they need to change their approach to market. A lot of people are going digital right now to ensure that their products are able to get access to the consumers that need them. So everybody cannot stay as it is. This is the new normal that we are in. It is not what we planned or emphasized, but just as the saying, when life gives you lemon, you make lemonade out of it.
Okay.
Okay, so Chief Jude.
Go ahead.
I just wanted to also provide a bit of context to the last question. The need to revise budgets upward or downward to make it more realistic should be seen from the lenses of two angles. Number one, are you talking about it from the point of view of financial reporting, i.e. you are trying to estimate value in use for the purpose of determining recoverable amount for the purpose of impairment? If yes, everything Omolara said is excellent. But I think there's also another side to it. If you're referring to budgeting and you need to revise same for the purpose of business management, that would be totally at the discretion of the business and based on their strategy. The pandemic is not all sad news for everybody. Contemporary times, government agencies are buying packs upon packs of Indomie noodles. So these are good times for D United as an organization. For telecoms company, Dimeji alluded to it where we started. God knows how much I've spent on data since this started, because since we cannot go out, telecommunication and information superhighway, internet, has become the means of communication. So these entities are actually experiencing their boom. So it's not just bad news for everybody. So if it is for the purpose of business management, it's at the discretion of the business and the business strategy that management has chosen to follow.
Okay, thank you. Thank you, Dimeji. And you take the next question too. How can an accountant differentiate between COVID-19 effects on financial operations and poor performance in this year, 2020, when conducting trend analysis of the financial statements? I'll take that again, please. How can an accountant differentiate between COVID-19 effects on financial operations and poor performance in this year, in 2020, when conducting trend analysis of the financial statements? Dimeji.
So in response to that, I actually think so many things will be attributable to COVID-19. if you look at them in the sense of financial reporting, for example, you want to do going concern assessment, you want to do value use calculation, that distinction will not be so important, because what we are concerned about is that are you going to be able to generate cash from the use of this particular asset, right? And we'll consider that. Will you still be able to be in business? So whether due to poor performance from other areas or due to impact of COVID-19, all this assessment taken together will be necessary. So I actually don't know the context of asking the question, but in the context of financial reporting, the two will be necessary to determine whether you are recognizing impairment on the non-financial assets or whether it is good you want to impair, or the level of restructuring you need to carry out so that you can survive under the current situation.
Okay, thank you. Thank you very much. The Senator, you take the very last question from this of today. If a company has 31st December 2019 year end, when should they assume the impact of COVID-19, knowing that it started in December in China and was declared an emergency by WHO in Nigeria in 2020 for proper classification into AE and NAE, that is adjusting events and non-adjusting events?
Okay, so thank you very much, Chief Jude Soniegbo. And I think that's a very important question. If you look at my slide 1, I had preempted this question, and I thought I provided some clarification. If your year end is 31st December 2019, Nigeria as an entity had no COVID-19 impact at that time. That is from the general consensus. So we hadn't recorded any case of infection. We hadn't recorded case of death. Everybody was still going about his businesses. These are businesses, the way we did. Banks were not closing. That's from the general consensus. From the regulatory point of view, Financial Reporting Council of Nigeria made a publication, and the link is on the second slide of my presentation, made a publication and told us that from the regulatory point of view, if your year end was 31st December 2019, COVID-19 was a non-adjusting event. Now, that's not a discharge. That does not mean there won't be effect of COVID-19 in your financial statement. So to the extent that COVID-19 impacted your organization, and to the extent that such impact are significant, after reporting period, of course, before the financial statement is authorized for issue, to the extent that the impact was significant and material, and to the extent that the impact will be significant to the understanding of your financial statement, you still need to make disclosures so that users of financial statement are made aware. So in summary, it was a non-adjusting event as at 31st December 2019, but if the impact is material, disclosure is required.
Thank you very much, the Senator. Distinguished participants, you will agree with me that it's been a very, very wonderful session. I'll still bring in the Registrar Chief Executive to thank our panelists and all participants in this first ever webinar of the Institute. I believe very strongly that it's going to be a very long series, perhaps an everlasting series. So on that note, I want to thank everyone. I want to speak to the some of the questions we've received about MCPE. The registrar will respond to that, but members should bear in mind that it's all about knowledge, not just about MCPE. The knowledge is what the Institute is very, very interested in. And then about the slides will be shared, like I already communicated. It will be shared very soon by the Secretariat. We have a very, very active and very, very up and doing Secretariat that has been working from home. So on that note, I want to thank you all and then bring on the Registrar Chief Executive to give us his closing remarks. Then we'll round off. Registrar.
Thank you, Mr. Jude. Let me start by thanking our most important people here. And the most important people are participants here. If not for them, we won't be here. Even though we can't see you, but we have been seeing the number increasing every now and then. And this program is for you specifically. So we thank you for joining us, for listening. To our presenters, I couldn't say anything but thank you so much. Please, all of you did a very wonderful presentation, and unfortunately we didn't have enough more time to give you. I can see you interjecting, cutting some of you. We apologize for that, but because we have to keep to time. Subsequently, we will try and see if you can give more time. Thank you so much for these wonderful presentations. To our speakers, to our participants, some of the questions, though Judah has already said, the slides, we'll definitely send them to your emails, the ones that you use in the registration. You get those slides. And for the video, we are going to have it on our website. You look at our YouTube channel on the website. You will get the videos for this presentation. Let me also indicate that certificates will be issued for participating in this webinar, but not just for people that will log in 1 minute and leave, but those that have actually participated. The logs will show how long you have stayed in participating in this particular program. And if you have reached certain number of percentage of the time here, you'll definitely be issued a certificate of participation in this particular webinar. It will be sent, an email will be sent to you on that. For MCPE credits, we're still working on that, awaiting some approvals because it has to follow the normal process of going through its the committee to approve that. We are working on it, but I can assure you we'll be able to get some MCPs for those that have actually participated, not just for those that have registered. For our MCPD programs generally, we are actually working on that too. Very soon, and within the next week or so, we are going to get a guidelines on how the MCPD programs is going to go on forward using this webinar series or e-learning platforms we are trying to put in place. So we'll get some guidelines on that. Finally, on my closing note, I would just like to say that this is the new normal. This is a new way of life. Operations have to change. We need to adapt to it and make progress on that. Having said that, thank you. Thank you so much, everyone. Thank you, our speakers. Thank you, Mr. Jude. Thank you, our participants. This is just first webinar in the series. We'll be giving you webinars every week by God's grace for the foreseeable future on different topical issues affecting the economy, affecting our institute, affecting our profession. On a weekly basis, we'll be broadcasting webinars. We try to get speakers that will come and professionals that will come and give us their experiences and how we can adapt to this COVID-19 pandemic and way forward. Thank you so much, everyone.
Thank you. Thank you, Mr. Registrar. Thank you, everyone. Let me use this opportunity to thank Mr. Henry of the Institute's IT department. Big ups to ICAN, big ups to ICAN Secretariat. God bless you all. Bye-bye.
Bye.
Bye.
Bye.